This is Tom Seifert, Senior Advisor here at Fairport Wealth. I was challenged by my colleagues to come up with a few planning ideas that we have seen and been currently using with clients where they fit into one's financial and tax plan. The ideas that I will be discussing are only relevant for certain client makeups, and not all would be warranted, or for that matter, necessary. One's individual situation will dictate the relevance of the idea and whether it would be suitable. Some of the concepts I'll be discussing are a bit sophisticated, involving many steps and decisions, so I plan on describing them in a somewhat high level. Let's get at it. Slide number 1. The first few ideas I'm going to talk about are in the estate and gift tax arena, and they deal with addressing and planning for a reduction in the estate and gift tax exemption. Currently, the exemption stands at $11.7 million per person, but there's talk in Washington about reducing that to either say 5 million or maybe even down to 3.5 million. However, even if nothing gets done in Washington, a real distinct possibility, the 11.7 million exemption is scheduled to go down to around $6 million beginning after 2025. To get assets outside of one's taxable estate and using the higher exemption amount available now, we are seeing the utilization of what is referred to as spousal lifetime access trusts, or SLATs, with varying iterations. This is a vehicle for married couples with extra investments. How it works. One spouse creates a SLAT, which is an irrevocable trust, and then makes a gift to the trust using some of their estate tax exemption. The other spouse would have limited lifetime access to the trust for his or her health, maintenance, and support if needed. And at his or her death, the trust assets would then go to the ultimate beneficiaries, being one's children's or grandchildren typically. Each spouse can set up a SLAT for the other, but you need to be sure that they are not identical. Lawyers know how to do this though. This is a great vehicle for those unsure if they will ultimately need to draw on those assets versus giving them away outright and having no access. Some nuances, if a liquid or privately held businesses are contributed to the SLAT, you may be afforded significant discounts. Also, you can structure the SLAT so that the grantor, i.e. the spouse setting up the trust, gets to pay any tax on the earnings within the SLAT. That's considered a hidden gift. So what has been accomplished by setting up a SLAT? One has used some of their current and perhaps temporarily generous estate exemption. Their spouse retains some access to the funds. Assets in the trust grow outside of your taxable estate and perhaps even tax-free if structured that way. Obviously with any planning ideas, there are some drawbacks, some complexity, some loss of control. Assets can even decrease in value, so you potentially have wasted some exemption. You don't get a step up in basis at death, or if the spouse has a premature death, the assets would go to the ultimate beneficiaries. But these issues can be all mitigated to a degree, but we'll save that for another time. I like the SLAT idea for those who want to do some planning, but not ready to give up control and full access to the funds. Another idea that we're seeing being used today is the old standby, the irrevocable life insurance trust, also referred to as an ILIT. With assets such as stocks and real estate growing in value over the last few years, and as mentioned, the possibility of a lower estate tax exemption, it makes sense to revisit the ownership of your life insurance policies. If you own a life insurance policy and die while holding ownership of that policy, the death benefit will be included as part of your taxable estate. So if you're planning on purchasing any life insurance, consider an insurance trust as owner of the policy. The trust can be written so that the annual premiums can be contributed to the ILIT using your annual exclusion, which is currently $15,000 per recipient, and thus not eating into your lifetime exclusion. When the death benefit is paid out to the insurance trust, it will not be included as part of your taxable estate, and the beneficiary of the ILIT, usually the spouse, then children, will have access to the insurance proceeds. Even if you have existing life insurance policies, you can transfer, i.e. gift it to an insurance trust. The value of the gift will be the interpolated value of the policy, which somewhat relates to the cash surrender value, but not exactly. However, it should be noted if you transfer an existing policy to an insurance trust, you must outlive the transfer by 3 years. Otherwise, it will come back into your taxable estate. The ILIT idea is back on the table for consideration. Sticking with the concept of reducing one's taxable estate and moving assets and their future growth to the next generation, the next few ideas on this slide take advantage of the current low interest rate environment we're in. These ideas basically have the impact of freezing the value of your taxable estate, but for a nominal expected interest rate of return, which is currently around 1 to 1.5%. The first idea is to set up a grantor retained annuity trust, commonly referred to as a GRAT. We love acronyms. The basic concept is that you contribute assets into a GRAT, ideally highly appreciating assets, and you pay yourself an annuity for a period of years, let's say 5 years. And whatever is left in the GRAT at the end of its terms, 5 years in this example, would go to your beneficiaries. The IRS assumes that the assets in the trust will only grow at a current low rate of 1.2%, and the amount of any taxable gift is calculated using that as the expected assets rate of return. So basically, any appreciation over that amount goes to the next generation. You can even calculate the annuity you are required to pay yourself back annually to eliminate any taxable gifts. This is called a zeroed out GRAT. The current administration wants to severely reduce the benefits of this technique, so if you think this may make some sense, you should consider moving on it. Another idea we are seeing is the increased use of intra-family loans. This is a much easier concept to understand and implement. You act as the bank and loan money to a child or grandchild to buy real estate, a stock investment portfolio, or say to start or buy a business. And you take back a note. This note needs to be a written instrument with stated terms and include a reasonable rate of interest. The IRS publishes applicable federal rates monthly, which may be used as the reasonable interest rate. The current midterm interest rate is exactly 1%. Also, there may be an opportunity for any existing intrafamily loans to be recast to today's lower rates. Once again, any appreciation above the 1% on assets purchased with said loan stays with the beneficiary borrower. Care should be taken, and terms of the note should be followed. Sticking with the low interest rate environment, another nuanced technique would be not only gift assets to the SLAT, which I described earlier, or perhaps another trust, but it is to sell assets as well and take back a note at the current 1% rate. Once again, freezing the taxable estate and moving almost all the appreciation to the next generation. I could go on, but just wanted to mention the possibility to supercharge the SLAT with a sales versus simply an outright gift. On to a few income tax strategies, and this is basically for those that are charitably inclined. Under the current law, the standard deduction was significantly increased, currently $25,100 for married filing jointly, and some itemized deductions were limited, such as the state and local tax deduction, which is now capped at $10,000, the so-called SALT deduction that you might have heard about. These two items had the effect of many more taxpayers taking the standard deduction versus itemizing, which they had probably done previously for many years. Only those married individuals with large mortgages or high medical expenses or those extremely charitable would theoretically now be itemizing on their tax return. One technique that we have been using is to establish a donor advised fund to, in essence, bunch your charitable deductions into one tax year, whereby getting you over the standard deduction and thus receiving a tax benefit for the gift. By way of example, assuming you're married and only have the $10,000 SALT deduction at your disposal. So in this case, you would not itemize, and you would simply take the $25,100 standard deduction. Assuming you normally give, say, $5,000 to charities annually, then your total itemized deductions for the year would be $15,000. The $10,000 SALT deduction, as well as the $5,000 charitable deduction. So in this case, it still would make sense for you to take the standard deduction and thus not getting any tax benefit for the charitable gift that you made of $5,000. You would have to give more than $15,000 to charity in a year before receiving any federal tax benefit in this example. So the benefit of a donor advised fund is that you contribute to it in 1 year, say 5 or 4 years worth of the $5,000 expected annual gift amount, and thus garnering a $20,000 to $25,000 charitable deduction, getting you above the standard deduction and obtaining some charitable tax benefit. So once the funds are in the donor advised fund, they are invested, and then you can make gifts to charity over time as you see fit. Clients, have used appreciated securities to fund the donor advised fund, and by doing so, the charitable deduction is calculated to be the fair market value of the stock contributed to the donor advised fund, and any unrealized capital gain goes untaxed. A donor advised fund can be set up at firms like Schwab or Fidelity very easily. There are proposed regulations out there, however, that might perhaps require a donor advised fund to kick out those funds within a 15-year period. Currently, there is no distribution requirements. So this 15-year period is for perhaps donor advised funds established after January 1, 2022. So maybe there's another incentive to get this in place this year if appropriate. Another item, for those who are over 70 and a half and annually give to charity, we recommend having them use distributions from their IRA to go directly to a qualified charity. You're not required to include the qualified charitable distribution in taxable income. So in essence, you get a full charitable benefit without having to get over any standard deduction thresholds just described. Plus, if you live in Ohio, you have the added benefit of not having the distribution be included for Ohio income tax. The direct transfers from your IRA satisfy all or a portion of your required minimum distribution depending on the amount. And the maximum you can give out of your IRA to charity in any year is $100,000. A qualified charitable distribution is easy to institute and use and highly recommended. Another area that we're seeing a lot of interest in and efficacy is trying to create tax-free income in retirement by using Roth IRAs and Roth 401ks. A Roth IRA is an IRA where you do not get any income tax deduction up front like a regular IRA, but what you contribute and any appreciation in the Roth IRA account comes out completely tax-free. Also, unlike a regular IRA, there is no minimum distribution requirement when you turn 72. You can let the Roth IRA grow tax-free for as long as you wish, maybe never tapping the asset and passing it on income tax-free to your beneficiaries. But let's assume you will need these assets to live off. Having assets in regular taxable accounts, regular IRAs, and Roth IRAs will allow maximum flexibility in establishing the most tax-efficient withdrawal scenario. There are several ways to get money into Roths. You can do a direct Roth contribution if you are below certain income thresholds. And if you happen to be above the thresholds, you can do what's called a backdoor Roth conversion. Assuming you have no regular IRAs currently, you simply make a $6,000 non-deductible regular IRA contribution. Then after a period of time, convert that to a Roth IRA. Since you took no deduction upon contribution of the regular IRA, you have basis in the IRA. So when you convert the $6,000 to a Roth, there is no taxable income. Alternatively, if you have an existing regular IRA out there, of which you use pre-tax dollars to fund, that is, you took a deduction when funding the IRA, you can simply do a Roth conversion or a series of Roth conversions, converting some of your regular IRA to a Roth and pay the income tax in the year you convert. We have seen this make a lot of sense for recent retirees for the period of retirement until age 72, the age in which required minimum distributions are required, as you now have available the lower tax brackets since you're not don't have the wages from your job. So, tax projections may be required to ensure that you're staying within certain lower tax brackets, which is why a series of annual conversions may make sense. Currently, many employers now have a Roth feature within their 401k plans that should be utilized to create the different buckets of retirement income. Especially younger individuals who are currently in the lower tax brackets should take advantage of Roths and or the Roth feature within their employer's 401k plan. Having a myriad of assets and account types can have a big impact on one's retirement and withdrawal options. Well, to recap, you've heard about SLATs, spousal lifetime access trusts. You've heard about ILITs, irrevocable life insurance trusts, GRATs, grantor retained annuity trusts, DAFs, donor advised funds, QCDs, qualified charitable deductions, and Roths, which are just some of the ideas that I've described in the previous slides and are for your consideration if applicable. This type of planning can be a bit overwhelming, but the effort put forth considering them could be worthwhile for you and your family. I hope you found this presentation informative and that it sparked some discussion with your advisors. If you have any questions or would like to discuss any of these ideas in further detail, as always, please reach out to your Fairport Well team and take care.